Hello, my name is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 1st of 2021. Please see our disclaimer for important information. Well, as we get started this week, I don't have charts for our high frequency data or the COVID tracker. Obviously, the trends in COVID are continuing. We're seeing a decline in the 7-day moving average of daily new cases as well as daily new deaths. Trend line is still very positive, but it essentially looks the same as it has over the last several weeks. We're seeing a decline in this particular wave. Obviously, the healthcare officials are monitoring additional variants and whatnot, but right now it appears that even though in some areas we are at a higher stage of acuity or concern, overall across the country we're seeing a decline. Now on the high frequency data, just a quick recap because there is weekly noise in the data. We did see a slight decline in TSA checkpoint data, hotel occupancy, steel production, saw a slight uptick in open table restaurant industry data. Just if you look at the numbers relative to where we were in the same period of 2019 on global commercial flights and TSA checkpoint data, we're about 19-20% below where we were. Restaurant open table numbers are about 6% below. Hotel occupancy is about 9% below. Still seeing relatively decent information out of some of the other areas. Rail car traffic down a little bit over the last month, but a lot of that has to do with supply chain choke points, which we have a couple of slides kind of talking about that as well. But in the slide that you're looking at right now, this is from the International Monetary Fund, and this is a quick check-in on U.S. household balance sheets. And we've been talking about this for actually quite some time. The fact that household balance sheets are in tremendous shape. Been a lot of debt pay down. A lot of the debt that we're seeing accumulate within the economy is coming at the corporate level as companies are taking advantage of low interest rates and adding to their leverage, and because they are expanding operations. We've got a slide in here coming up. Capital expenditures and capital spending expectations are moving higher. But at the household level, we see the consumer in relatively good shape, even though we know that people with high credit have been refinancing their mortgages and doing cash outs and things like that. Obviously the net worth includes not only the concentration of real estate, which is reflected here in the green line, in the housing as well as second homes and investments and things like that, but also the stock market. But in this one, I thought it was really interesting to show the influence on real estate. As we've been talking about higher home prices overall and across the country, those prices seem to, at least the rate of acceleration is abating somewhat, but they're still moving higher. And you can see here the tremendous influence that real estate has had in owners' equity and that ratio of net worth to disposable income. Here's a quick look at consumer confidence. This is Conference Board data. You can see that confidence remains reasonable. We've got a consumer comfort index, which is maybe not quite as optimistic. Present situation minus expectations is in that dotted line. You can see here that this data is kind of compiled for us by Bloomberg. You can see it's actually fairly positive. Future expectations maybe a little bit subdued over the last several months. Of course, we've had the rise in the Delta variant. This number comes to us at pretty much real time, but you can see June through August and September, we had a decline in future expectations. Present situation, same story there, but we're on an elevated base, and you can see before the pandemic, we're just slightly below where we were in present situation, as well as future expectations. And then the Conference Board consumer confidence number has been fairly stable, fairly conducive overall. Total number of people that are claiming unemployment insurance benefits. I thought this was really interesting because we talked about the potential input or impact, I should say, in August with a lot of the termination of the extended unemployment and special unemployment benefits that people were receiving. And this chart shows us the impact of that. So we had a huge drop in the number of people that were claiming this unemployment insurance benefit because of the cessation, if you will, of some of these programs. And you can see this green area here highlights the fact that it declined by 8.8 million people since the end of August. Pretty tremendous trend here. Here's a look at personal consumption. We've shown this chart to you before. There's a very clear trend line pre-pandemic that you can see here. And then as we've cycled through the pandemic, we're on a definite recovery in personal consumption. As we just saw, consumer balance sheets are in great shape. Incomes are moving higher, but we're seeing the wealth effect take hold. We've got not only the stock market, but as you saw before, real estate is contributing to a fair amount of consumer confidence and spending. And this is important on this slide because this was the most impacted area. Now, we know that personal consumption on goods has been tremendous. In fact, we're above where we were pre-pandemic. A lot of appliances and durable goods, people buying Peloton machines and things like that has been strong. But this is services. So this is reflective of the reopening of the economy. And that number continues to be real strong, although we are below that trend line that we had established pre-pandemic. Wanted to show you the latest data on GDP. This is quarter over quarter. This number came out just recently, and as you could see, we had a bit of a shortfall. The survey expectation was for about 2.6%. We actually got about 2% on that, but you can see it's coming on the heels of some really strong quarters, and the number is positive, but it's just slowing down. We expected a slowing of economic output. This is not a terrific surprise. I want to direct your attention over to the right-hand side. We've got a couple of slides or a couple of charts coming up that kind of break down and derive the sources of gross domestic product here in the third quarter. And by the way, this is the first reading that we're getting of this. It'll be revised twice before it's made final. But in the right-hand side, you can see consumer spending. Again, we've seen that it's been strong. We see the services spending is going up, but the contribution to GDP was not as strong in this last quarter as it has been. And if we look at inventories and business investment, I mean, these are two areas that we know are going to benefit us in the quarters to come. Now, we've already said on the right-hand side, business investment is picking up, capital spending expectations are increasing, so we know that there's spending on the horizon. Businesses, on balance, are generally more confident, and obviously you have to have some degree of confidence if you're a business owner and you're committing to spending more money to expand your operation, to expand output, so on and so forth. Last quarter, we didn't have as strong a benefit from business investment as we have in prior quarters, very similar to the consumer side. Now, we expect that number to pick up. What's interesting on the left-hand side is the inventory contribution in GDP growth. This is something that is really intriguing here because of the supply chain choke points and a lot of the logistics, the clogs in the distribution chains and whatnot, lack of drivers for overland truck transport, so on and so forth. We've seen inventories be depleted, and anybody who's looking for Christmas items or beginning to take on that activity is probably, you're probably seeing some of the impact of that things are hard to get, they're in limited supply, they're back ordered, delivery times are being pushed out, so on and so forth. But inventories are being replenished. And I think, as we talk about the supply chain issues, which will take a while to get worked out, but it's going to lead to a net benefit to economic output and economic growth from inventory build and rebuild. And you can see here in this last quarter, that we have had a net benefit. In fact, 2 percentage points of benefit to GDP, whereas in the prior 2 quarters, we saw a net drag just because their inventories were not being replenished and things were really clogged up. And I do think that even though the supply chain choke points will continue to take a while to resolve themselves, particularly on the semiconductor side. I mean, that could take quarters. It could take another year, in fact. But I think we will see an abatement overall in the supply chain issue. All right, so this is a quick look at federal spending as it relates to GDP, and this is a part of the equation, right? The CIGX, and government spending, we know, has been very strong. In response to the pandemic, you can see those blue bars, the CARES Act, American Rescue Plan. We are waiting for additional stimulus, and that's being held up in these massive debates in Congress right now. And not to get political, but obviously there's a lot of speculation and uncertainty with regard to what's coming down the pike insofar as stimulus is concerned. But you can see here during the interim that we've had a net drag on economic performance because federal spending has declined from these very high levels that we saw in response to the pandemic. Now, we've been talking about spending overall, and we saw that services spending on the part of consumers has really picked up. This is a quick look at durable goods orders. If you back out transportation, we know aircraft's been a little bit lumpy lately. Fleets amongst the airlines across the globe, they're being very careful with the management of their inventory. And so we haven't seen a lot of benefit out of the transportation, or lumpy benefit. But if you back that out, goods orders, durable goods orders are continuing to move much higher. We've got some data here recently from the Kansas City Fed. I always take a look at these regional Fed surveys to kind of get a mosaic together of what's going on around the country. And you can see that there's a very strong corroboration across the various areas. I mean, we saw the Empire State, which is a New York area. We've seen the Dallas area surveys, and we've seen the West Coast and Cleveland surveys all kind of mimic the same kind of trend here. Manufacturing, very strong. We did see a bit of a pause when some of the supply chain issues were kind of most pronounced, and essentially raw materials and inputs were hard to come by, and so manufacturing slowed a bit. And again, we haven't really resumed the momentum, but we're at a reasonably happy place right now with regard to manufacturing. And here are a couple of inputs, and these are things that I think are going to continue to play out for a while. But we're seeing levels that we haven't seen in a tremendously long period. And you've seen these charts before in various forms, and like I said, you've seen them in other Fed surveys. But this is actually kind of a summation of responses from respondents to the poll that the Kansas City Fed has put out to its constituent businesses in its district. And you can see prices paid for raw materials continues to trend higher, as well as supplier delivery time. So again, while I think that we may see a little bit of a slight easing of the supply chain issues, what this is telling you, these two charts here are telling you, is that raw material input prices are going to remain high for a while, and supplier delivery times are not going to return to normal for a while. Here's a quick look at the Baltic Exchange Dry Index. What's interesting here, this reflects essentially global shipping prices, and this is it reflects overseas or seabound transport for a lot of things, commodities and agricultural and other items on seaborne freight. And you can see that this index has really plummeted. I looked at this chart and it made me optimistic. Digging into the details, however, it looks like a lot of this is driven by Chinese coal. We've seen a lot of price price decreases here on Chinese coal as of late, and this has had an impact on the Baltic Dry Index. And I thought I'd show you some information here from the related to certain elements of the business condition survey that's produced by the National Association of Business Economics, NABE. And this reflects both wages and prices. And so both are moving in the same direction by a very similar amplitude. And it just reflects that, from a broad swath of the business community, that we are seeing those wages move higher and we are seeing prices move higher. So I don't know that I would say that I'm terribly surprised at this data, but it just seems to corroborate everything that we're seeing both from these Fed surveys as well as GDP inputs and what we're seeing in some of the freight indices and so on and so forth, and what we're seeing in the employment cost data as well. So with the backdrop of prices and wages being higher, there's a lot of speculation on inflation. We did see a much weaker GDP or economic growth print, as we saw earlier. We were expecting about 2.5 to 2.7, and we got basically 2%. So, but nonetheless, here we're seeing increased inflation expectations. We'll see this in a minute in the bond market. But you can see the rate hike probability has really moved higher and moved up. And what do I mean by all that? It just means that the probability of a rate hike sooner rather than later is moving up. And so the kind of the amber or orange bar, if you will, that was where we were at the end of September. Now where we are 1 month later is in that blue, and you can see that there's a much higher probability of having a rate hike in let's say May, June, July, August than there certainly was even a month ago. And obviously this can change rather quickly, and it's worth monitoring because inflation expectations can change rapidly, and we know that we're seeing a lot of input costs into production that will eventually resolve themselves out. I do think, though, that wages, rents will be a little bit sticky. They're much more influential in the consumer price index than they are in the personal consumption expenditures index that the Fed looks at. But this is just really a reflection of people's expectation that not only we're going to get that tapering of asset purchases sooner, that we're also going to get those rate increases a little bit sooner as well. And here's a reflection of that. I will tell you, though, that the one on the left, the chart on the left, as we saw, this is the break-even rate. It is essentially taking the Treasury inflation protected security for the 10-year Treasury, the tip, if you will, and subtract that yield from the 10-year Treasury, and you can see that gives you a break-even yield. That gives you essentially what the market's interpretation of inflation is looking like, and that peaked at 2.7 after the Fed made its after the latest GDP report was released. You can see that dropped down about 2.6, but it remains high. And the chart on the left is a time series. It just goes back to the beginning of the month. So I thought it would be real helpful to go back many, many years and show you what that looked like. And as you can see here in the chart that's produced by the Daily Shot, that 2.7 is actually pretty meaningful, even though it doesn't seem terribly high to us, for looking back over the last 70 to 80 years, that 3% inflation has kind of been the norm, even though we've had a secular decline in inflation over the last 20 years. But you can see that the 10-year break-even rate of 2.7, even that level, is something we haven't seen for quite a while. As you can see that line that draws us back to 2006, 2008, we kind of got close to it a couple of times. in the post-global financial crisis recovery, but we have not seen that level in many, many years. So what we're seeing in the bond market, which is really actually pretty interesting here, is that the 30-year, the long-term inflation, the long-term treasury rates have not moved up as much as the 10-year has. And so what we've seen up in the upper part of this chart, you see essentially the 30-year treasury yield minus the 10-year treasury yield. And you can see that difference has gone down. And that's because 10-year rates have moved higher. And 30-year rates haven't moved as high and as pronounced. And we know that short-term rates are pretty anchored. So we're seeing a little bit of a bubbling in the middle of the yield curve. And you can see that the 10 to 20-year expectations for inflation have moved higher. We basically saw that in the last chart. So that's had an influence on those yields, but the 30-year yields have really not moved as much. And what's interesting here is that if you take the 30-year treasury and subtract the 20-year treasury, we're actually inverted on that part of the yield curve. And what does that mean? That if you take the 30-year yield, which ordinarily will be higher because you get a term premium for extending your maturities, but if you subtract the 20-year, you actually get to a negative rate. So 20-year yields are higher than 30-year yields. And that's a very interesting development. It's a very interesting dynamic. It reflects kind of higher, more near-term or interim-term inflation expectations, but the market is still somewhat confused on that long-term number, that basically inflation over the next several years, maybe up to 10 years, is going to be higher than what it's going to be over the long term. Now, I've got some charts from Fidelity's presentation, which I thought were pretty interesting. So as we look at global earnings growth, and this is over the trailing 12 months, literally as we're heading into the earnings season. So this is as of the end of last month. You can see, whether it's the emerging markets, developing markets, or the U.S. itself, they're all moving in the same direction. So we've got earnings that are increasing across the globe. Consequently, we are actually seeing inflation increase across the globe as well. But as you can see here, forward earnings they're moving higher. And U.S., I think that may be understating a little bit where we actually are, because the U.S. market is more richly valued than other markets are. But we can see that this is a global recovery. We can see here that we are getting a positive earnings response out of these developing and emerging markets, and is contributing to global GDP growth. And here's a quick look at valuations across the globe. As we were kind of alluding to a second ago, you can see the dotted lines represent the long-term averages for U.S. developed markets and emerging markets. And you can see the U.S. and developing markets tend to be a little bit higher than emerging markets. But this supports the argument that I've been making for some time, is that international markets are more attractively valued right now. You've got essentially developed markets that are trading below their long-term average. You've got emerging markets in many respects that are also kind of trading, I guess you can call it, kind of almost in line with their long-term averages. But relative to the U.S., they're a lot less expensive. Now, the interesting development is that we've actually been seeing earnings move up faster than prices. And so this is a chart, a trend line chart of price to earnings ratios over the trailing 12 months, over the last 12 months. And we've seen such strong earnings increases globally that multiples have actually come down. And you can see they've come down both in U.S. as well as international markets in a fairly similar fashion. And so the relative trade-offs, the relative value propositions have remained intact, even if global valuations have actually come down. And as we look at kind of relative valuations by geography, this is maybe a little bit of a busy chart, but you can see here that on the left-hand side of this chart, you've got cyclically adjusted price to earning ratios. The dots represent where we were at the end of August. Again, a little bit dated, but I thought it was interesting because it's, the relative comparisons really haven't changed over the last couple of months. But you can see in the blue shaded areas on the left-hand side, that gives you your 20-year range. And if you isolate EM, emerging markets, DM, developing markets in the US, those bars are kind of broken out in kind of that green color. But you can see as you look across the countries in some of these regions, the US valuations, you've seen more amplitude and or range, I guess, in some of these other areas. But the fact is that where we were at the end of August, insofar as the U.S. is concerned, we're at the high end of that 20-year range. Whereas you look across to the left of the U.S. and you can see that all these other areas are trading, below their peaks, like all the way over to, like, say, Turkey as an emerging market. They're trading at the bottom of their 20-year range right now. And so this is kind of what I've been talking about with regard to this relative value proposition, that we've got these other areas across the globe, the non-US markets, that are really not nearly as expensive relative to their 20-year averages as the US is right now. And then on the right-hand side, you can see the valuation of major currencies versus the US dollar. I thought this was kind of interesting that most of the currencies relative to the US are cheaper, except for the Chinese yuan, and which is more expensive right now than the US, more expensive in dollar terms than the other currencies are. Here's our dollar index. So we've seen over the month of October, we've seen a little bit of decline in the dollar, which is maybe a tad unusual in the sense that we are seeing higher inflation with the prospect of higher interest rates. We already saw in a few charts ago that the 10-year yields were moving higher and creating this weird inverted part of the curve from 10 to 30 years. But when the GDP number was announced and it was below expectations, we did see where this red arrow indicates a drop in the dollar, feeling that growth is not going to be as outsized, perhaps maybe slowing a little bit, albeit positive. And so that took a little bit of steam off the dollar. And it's going to be interesting to watch what happens to the dollar, because typically, if you have rising rates, particularly rising rates in the U.S. relative to the rest of the world, you would have a strengthening dollar. But in this case, what's interesting is that we are seeing tightening and we are seeing inflation across the globe, and we've got other central banks around the globe that are already raising interest rates, whereas the U.S. Federal Reserve has been very hesitant to do that. And so as a result, we have seen a bit of easing in the dollar as of late. And I do think the dollar is probably poised to kind of maybe lose a little bit more ground before it starts to move back higher. And this is kind of what I was talking about. If you map this, basically the twin deficits as a percent of GDP and the trade-weighted dollar index, which is also depicted on your screen here in the red line, there's a reasonable positive relationship here. In this chart, if you look at the twin deficits, trade and fiscal deficit, you can see that it would seem to imply that we're going to have more weakness in the dollar looking ahead. I'm not sure that you're going to have a cratering in the dollar, but I think it probably, is safe to say that the risks for the dollar are on the downside as opposed to strengthening here over the near term. Risk-adjusted returns is something that we spend a lot of time thinking about, and obviously, in managing portfolios for clients, you want to manage risk, and you also want to balance your risks in your portfolio to where you're having you're lowering the overall volatility of returns. And one thing that we look at here is risk returns adjusted for risk in various areas of the market. And so, this particular chart from the IMF isolates different areas like tech, leverage loans. You see the S&P 500 here. That the last year, we've had really strong returns, and we haven't had a lot of volatility in the market. And so risk-adjusted returns have actually been pretty good. You can see here, Bitcoin has had a fairly strong run. We've had actually pretty strong run in emerging market equities relative to risk. And so, again, it's not just aggregate return, but it's what it does in aggregate return relative to the amount of risk that you're taking on to try to get those returns. And you can see here, crypto and Bitcoin have really been pretty strong over the last year, even if they haven't been very strong over the last 3 years. So looking ahead, obviously, there's some concerns, I think founded concerns on the S&P 500, but you've got these other areas too, and particularly emerging market equities that are pretty interesting in terms of the contribution to total return relative to the amount of risk that you have to take to get it. And we've been watching the oil markets, energy markets. We know natural gas is really high, and so a lot of energy producers have switched to coal because it's cheaper. Now we've got a run on coal, and coal supplies are really down. So we've got energy prices across the entire commodity basket that are much higher right now. And you no doubt will notice that the next time you go fill up your vehicle is you're seeing higher prices at the pump. These are essentially higher crude prices that are being passed along through crack spreads into their distillate products. But you can see here that we've got consumption that had dipped after or during the pandemic, I should say, has now recovered. So we've got a lag in production as that dotted line represents. That's kind of where we are right now. And as we transition to 2022, this data from the International Energy Agency, or IEA, suggests that we're going to be back into surplus by the time we get into the middle of next year. And so once we get back into surplus production, meaning production is higher than demand, then we'll begin to see the easing in those prices. So we've got a few more months to I guess wrestle with, and in some cases enjoy higher prices if you're an investor, but not if you're a user. But at some point, this is going to abate somewhat, and we're going to normalize on our energy price basket. And as we talk about equities, we've got a few charts here at the end. This is a chart of fund managers, and we've shown fund manager survey information from Bank of America before. What this is showing you is that in that light blue number, the net percentage of those managers that expect a stronger economy has really kind of rolled over. Obviously, we saw a weaker GDP number last week, and so there's an expectation on balance on the part of fund managers that growth is going to be stalling out a little bit. Again, not a surprise. Don't think it's going to be negative, but the opinions on the part of fund managers really dovetails with that. Now, the oddity, though, is that fund managers are still vastly overweight equities, and that's in the dark blue line. So, it's kind of like putting your money where your mouth is. You feel like growth is going to slow, but equities really, in some respects, it's kind of like what they call TINA. There is no alternative. And equities have really been the place to be. And so fund managers are kind of, with their backs to the wall saying, well, where can I go to get return right now? And a lot of them are still in the equity markets, in the U.S. equity markets. Well, as we look at the equity markets and the S&P 500 in particular, we can see that the earning expectations for the fourth quarter are actually moving higher. What this chart represents is kind of a forward look, like as we're now in the middle of third quarter earnings season, essentially for the period of July through September, we're looking ahead to what the expectations are for the fourth quarter, which would be obviously October through December. And those numbers will get reported really starting at the beginning of January. But the expectation as we sit here today is that we're seeing the expectations are moving higher for fourth quarter, if that makes sense. So, we had an expectation embedded for fourth quarter earnings as we ended this last quarter, but that expectation has moved higher. So on balance, you have more optimism for fourth quarter earnings despite all of these headwinds, the supply chain choke points and all these logistics issues, that despite that, earnings expectations are moving higher for the fourth quarter as we sit here today in third quarter earnings season. And we continue to see a lot of buyback on the part of companies. This is reflective of companies having a lot of surplus cash flow. It's a function therein of having a higher earnings base and earnings moving higher, so that generates cash flow. And companies are looking for opportunities to deploy that cash. They're beginning to spend a little bit more on capital items, on production, things like that, but they're also buying a lot of their stock back. And something else that I wanted to look at here was S&P 500 performance before and after you have capital gain tax increases. And this is one of those things that has been talked about in the tax proposals that are now being discussed up on Capitol Hill. And I came across this from JP Morgan. I thought it was very interesting that essentially the anticipation of increased taxes on capital gains definitely has a negative effect. Well, let's say definitely on balance, it has a negative effect. It didn't in 2012, 2013, but it did in some of the other times that, where these increases were being discussed. But in the aftermath of the implementation of the tax increases, S&P 500 actually performed very, very well. You can see here the average is almost 18%. Again, not to get too carried away with aggregate numbers, but directionally, I think it's important to realize that maybe if capital gains is included in the tax proposal, then it's not necessarily viewed as a as a negative. Well, and I'm going to conclude on this slide, and this is for all the conversation on taxes and especially on corporate tax, in the 2017 tax legislation that went in, it dropped the U.S. federal corporate income tax rate down to 15%. However, what's really interesting is in the aftermath of that, tax rates dropping fairly dramatically. You can see in the bottom part of this chart that tax receipts, tax revenue actually hit an all-time high in this last year. So all the conversation about revenue from corporate taxation sources maybe being impacted by the legislation in 2017 that went into effect in 2018 is actually not well founded, because the numbers don't lie, and we had record tax revenue from corporations in 2021. Well, that will do it for this week. I hope you've enjoyed the chart pack on behalf of the entire team at BKA. Hope you have a wonderful week, and we will talk to you again soon. Take care. Bye-bye.